$2,200. Yeah, that is roughly what the average American is now paying for car insurance every single year. It's a completely staggering amount of money. And honestly, for a lot of people, it feels like it just keeps going up and up, no matter how safely they drive.
And while you're out there paying those record high premiums, the insurance companies, well, they're quietly celebrating. In 2025, the personal auto insurance industry collected all those premiums and turned around to have one of its most profitable years in over a decade. But here is the thing we really need to understand. That isn't a coincidence, and it certainly isn't just bad luck on your part. That is the business model working exactly the way it was engineered to work. Welcome to The Explainer. Today, we're going to look at car insurance through a completely different lens. We aren't going to look at it as some neighborly safety net. Instead, we need to view it as what it actually is. A casino. It's basically legal gambling, just with slightly better lighting, a massive call center, and a much, much bigger lobbying budget. We're going to open the books today to see exactly how they set the table.
So here is our roadmap. Number 1, welcome to the casino. 2, how the house sets the odds. 3, cashing out your chips. And 4, how to shift the odds back in your favor.
Okay, let's jump right into part 1. Welcome to the casino, the high-stakes game of auto insurance.
Get this. By the time you hit your 40s, if you're just an average driver, it is a mathematical certainty that you'll have paid an insurance company more money than your vehicle is even worth, and that's likely without ever filing a single claim. Now, when you pay into a system for decades and get literally nothing back, you might feel unlucky. But in a casino, paying in without getting a payout isn't bad luck at all. It's the core business model functioning correctly.
Which brings us to Section 2, how the house sets odds, the math. So every major insurance company employs huge teams dedicated to actuarial science. Sounds fancy, right? But actuaries are essentially just professional odds makers. Their entire job is to calculate the statistical probability that you will file a claim and exactly how much it will cost them when you do. Structurally, it is identical to how a casino prices a blackjack table. The house doesn't need to win every single hand. It just needs the math to work in its favor across millions of hands. Auto insurance is the exact same principle, it's just wearing a suit instead of a dealer's vest.
So how do these actuaries set your specific odds? Well, they use variables. Before an insurer knows a single thing about how you actually behave behind the wheel, you're getting priced on dozens of data points. They stack up your age, your zip code, your driving record, the exact type of vehicle you drive, your marital status, and, in most states, your credit-based insurance score. It's entirely statistical. It is never personal. They are literally just stacking chips on the table based on demographic probabilities.
And I really want to hit this point hard because it shocks almost everyone who learns it. According to 2026 industry data from Bankrate, drivers with poor credit can pay up to roughly 105% more than drivers with excellent credit for the exact same coverage. Let that sink in for a second. Your financial credit history often matters significantly more to your insurance premium than your actual physical driving record. Crazy, right?
Now, all of this highly calculated odds-making funnels into one ultimate scorecard that you will never, ever see in their funny television ad campaigns. It's called the combined ratio. It represents the share of every premium dollar that goes back out the door to cover claims and operational expenses. If the number is below 100, it means the house turned a profit on underwriting alone before they even touched a single cent of investment income.
So just how much did the house win recently? Well, pulling from Insurance Information Institute data, the 2025 personal auto industry average came in at an incredible 91.8. But for the biggest names in the industry, companies like Progressive, Geico, Allstate, Travelers, Moody's reported their combined ratio was a shockingly tight 86.4. That means for every single dollar you gave them, they kept over 13 cents in pure underwriting profit. The house is doing exactly what it was built to do.
All right, moving on to Section 3, cashing out your chips, the claim.
So, what happens when you actually file a claim? An adjuster evaluates it, and it is incredibly tempting to picture this person as your personal advocate, but the reality of the organizational chart is very, very different. Now, they usually aren't hostile, but the adjuster is an employee reporting to a company whose profitability relies strictly on paying out as little as your policy legally requires. It's not some grand conspiracy, it's just the business hierarchy at work. Because of this exact incentive structure, if you look at state insurance department complaint data, you see the exact same friction patterns pop up over and over again. Insurers will request additional documentation that drags out the timeline.
They'll offer valuations for your vehicle or your medical needs that land suspiciously under independent estimates. Or they'll make premature settlement offers before you even know the full extent of the damage. The burden of proof, and frankly, the burden of patience, sits entirely with you, the driver.
But let me ask you this. What happens when the accident isn't your fault? What if someone else hits you? It seems like an open and shut case where your insured doesn't have to worry, right?
Well, this introduces a secret mechanic almost nobody knows about. The crucial point here is a process called subrogation. If you get hit by someone else, your own insurer can pay your claim to get you sorted out quickly, but then they turn around and legally pursue the at-fault driver's insurer to recover that money. And here's the real kicker. Sometimes they actually recover more money from the other company than they originally paid out to you. It is completely legal, it's entirely routine, and it is just one more example proving that the underlying math is built to protect the house first.
Let's move to our final section. Section 4. How to shift the odds. The fix.
So there are actually 4 distinct moves that work to quietly improve your hand. Number 1, shop your policy annually. Number 2, leverage your deductible. Number 3, strategically build your credit. And number 4, obsessively document your evidence. Let's break these down to see why they are so effective.
First up, the simplest but most ignored rule. Shop your policy every single renewal. For genuinely comparable full coverage, national data shows a spread of roughly $1,450 to over $3,000 a year between major carriers. Loyalty is absolutely not rewarded in the insurance game. New customers get the sharpest pricing, and insurers rely heavily on the fact that most people are simply too busy to check.
Second, treat your deductible as a lever, not a fixed cost. If you move your deductible from $500 to $1,000, it typically guarantees a 10 to 15% drop in your premium. Now, obviously, this only makes mathematical sense if you genuinely have that $1,000 sitting in a bank account ready to go. Otherwise, you're trading a guaranteed smaller bill for a hypothetical bigger one you can't actually afford. But if you have the cash buffer, pull the lever.
Third, we circle back to that shocking statistic from earlier. Because most states allow credit-based insurance scoring, your credit score is quietly acting as your insurance score. The exact same boring financial habits that build your credit, paying your bills on time, keeping your credit utilization low, they are a backdoor way to lower your insurance rates. You are essentially proving to the actuaries that you're a statistically lower risk.
Fourth and finally, win the claim before it even happens. The absolute best way to win a claims dispute is through preparation you do while nothing is wrong. Keep dated photos of your car's condition, save your maintenance records, buy and actually use a dash cam. Generating a paper trail won't prevent an accident, but it turns an adversarial claims process into a negotiation based on hard, undeniable evidence rather than fuzzy memory.
Let's wrap things up with this thought. Doing these 4 things won't magically rewrite the underlying structure of the entire industry. The house still sets the odds. You just don't have to play blind anymore. Odds are not the same thing as certainty. By understanding how the math works, you empower yourself with a statistical advantage to quietly improve your hand.
Car insurance isn't going anywhere, but neither is your new understanding of exactly how to navigate it. But here is something to leave you with today. If you think the math behind car insurance is fascinating, are you ready to see how health insurance runs on an even stranger version of this exact same playbook? If you want to see that breakdown next, let me know in the comments. Thanks so much for learning with me today, and I'll see you in the next explainer.